Well, good afternoon on behalf of David, Chris and myself. Thank you all for participating in our Human Capital webinar, which we've just managed to squeeze in before the England versus Wales game. And we'll finish with plenty of time before the kick-off, so no concerns on that front. As you may be aware, there have been some fundamental changes to the legislation governing entrepreneurs' relief, which I'll refer to ER throughout this webinar. These changes have taken place over the last 2 years in response to what HMRC considered to be targeted abuse of a very generous tax relief. We'll endeavour during the course of the next 60 minutes to bring some clarity to this area. The session is designed to be a practical guide for employees, directors and investors, flagging changes in the legislation, and as it's quite a technical presentation, we'll provide lots of worked examples and practical experience along the way. So, just moving on to the agenda. So in terms of running order, I'll provide a high-level review of the changes that were made to entrepreneurs' relief in the Finance Act 2015 and briefly explain why they were made, followed by a more comprehensive review of the effects of ER changes to joint venture companies and partnerships that are to be enacted in the 2016 Finance Act. Chris is going to give an overview of the investors' relief, which was unexpectedly announced in the 2016 budget, and then David will briefly review the existing EIS, SEIS and VCT tax-efficient investment wrappers, and then consider the interaction between investors' relief and the existing reliefs. By way of background, ER is available to employees and office holders who realise qualifying gains. It operates so as to apply a 10% rate of CGT to qualifying gains up to a lifetime limit, which is currently £10 million. In the absence of ER, gains are currently taxed at 10 or 20%, unless the gain relates to the sale of residential property or carried interest, where it's taxed at the old 18 or 28% rates. So, looking at the qualifying conditions, we don't have time to review the ER qualifying conditions in any detail, but in essence, for 1 year before the date of disposal, the following ER conditions would need to be satisfied on the disposal of the shares in a company. First, the company would need to either be a trading company or the holding company of a trading group. The second requirement is the shareholders would need to be an officer or employee of the company or group company. And finally, the shareholder needs to exercise at least 5% of the voting rights and owns at least 5% of the company's ordinary share capital, and that is calculated by reference to nominal value. The anti-avoidance provisions introduced in the Finance Act 2015 were based around the first of these three conditions, namely restricting an investing company's ability to be a trading company or the holding company of a trading group for ER purposes. And the way it did this was by preventing the company from being treated as carrying on a proportion of the activities of the joint venture company, and in respect to partnerships, by treating the activities carried on by the company as a member of that partnership as being non-trading activities. Now, this had quite a profound effect on many corporate structures. And a trading company for these purposes means a company carrying on trading activities whose activities do not include, to a substantial extent, activities other than trading activities. And substantial in this context means more than 20%. So therefore, if in any of the examples that we will go on and look at, the company in which the individual holds shares has its own trade, then providing that any non-trading element which is attributed to the company is non-substantial, i.e. it's less than 20%, then the company should still be a trading company for ER purposes. So if we just look at the joint venture companies, there's always been rules within the legislation which set out how you would treat a joint venture holding and whether it should be treated as an investment or as trading activity. Now, we don't really have time to delve into the joint venture rules, but as a result of the way in which they were drafted, some companies use them to create somewhat artificial arrangements in order to allow more than 20 employees or office holders to qualify for ER on their shareholdings in trading companies, with an indirect shareholding which is far lower than the 5% threshold. And these are often referred to as mancos or feedercos. Now, providing the joint venture rules were satisfied and assuming that the feederco had no other activities, it would have been regarded as a trading company for ER purposes on the basis that the investing company would have been treated as carrying on a proportion of the activities of that joint venture company. So if we look at an example here, this was kind of like the typical feederco or manco structure. And at the extreme here, you can have management holding through their feederco structure, holding a 0.5% indirect holding in the actual trading company, and still being able to qualify for entrepreneurs relief. Now, HMRC objected to these type of feederco arrangements as they were seen as contrived structures to claim ER in circumstances which was never really envisaged when the legislation was introduced. So, as a result, the Section 43 of the Finance Act 2015, as I noted at the outset, closed down these type of structures. However, the Finance Act amendments had some unexpected and adverse consequences in that they impacted on a large number of genuine commercial arrangements. Now, the government, after much lobbying by representative bodies, has introduced a number of measures in the Finance Bill 2016 which will retrospectively reverse many of the restrictions introduced in the Finance Act 2015. However, as unfortunately the way things are, that it didn't reverse all of the changes, and it has inevitably now been drafted in a way which increases the complexity of the legislation. The Finance Bill 2016 contains new definitions of trading company and trading group for ER purposes, in addition to the introduction of 5 key formula that need to be applied to determine whether or not an employee or office holder of a company can qualify for ER. So, if we have a quick look at the formula. The formula is a kind of a gateway of sorts in that it produces an answer determining whether an employee or office holder holds more than a 5% indirect interest in the underlying entity. And then once we've got that answer, if it's more than 5%, we revert back to considering whether the relevant joint venture company or the partnership are actually carrying on a trade. Now, the new provisions state that for ER purposes, a joint venture company's activities will only be attributed to the company, which is now described as an investing company, which held shares in the company in which the individual is looking to claim entrepreneurs relief, if at least 5% either directly or indirectly of the shares and votes are held in that joint venture company. So we've got 2 tests. We've got the shareholding test, which is based on a formula, R multiplied by S multiplied by 100, where R is the fraction of that the employer office holder has in the ordinary share capital of the investing company, and S is the fraction of the ordinary share capital held by the investing company in the JV company. And the voting test is measured by the formula T multiplied by U multiplied by 100, where T is the fraction of the voting rights held by the employee or office holder in the investing company, and U being the fraction of the voting rights held by the investing company in the JV. So when you multiply the 2 together, you kind of get the indirect interest. So those of you who like formula will be loving these tests. A very important point to note is that there is an assumption where the investing company owns more than 50% of the shares and or votes in the trading company, it's treated as owning the whole of the shares. And although the formula are very complicated, it's a little easier to understand how they work when we look at some examples. So if we look at here at example 1, we've got 3 shareholders, P1, 2 and 3, who together own 100% of the shares in the investing company, which is IC on the graph. The investing company owns 20% of the shares and votes in the underlying JV company. So in order to determine whether P1, 2 and 3 get through the ER gateway, we need to apply the formula to their holdings in the investing company and then the investing company's holding in the JV company. So if we start with P1, She holds 55% of the ordinary share capital in the investing company, and for simplicity, we've assumed here that the ordinary share capital and the votes are the same. We multiply her 55% holding in the investing company by the investing company's 20% holding in the JV company, and then multiply this by 100. This means that P1 has a 11% indirect holding in the JV company, and therefore P gets through the ER gateway. We would then consider the JV rules and whether the JV company is a holding company of a trading group. Assuming both of these conditions are satisfied, the investing company will be a trading company for P1. Therefore, she should be eligible for entrepreneur's relief on the disposal of her shares, provided that she satisfies the other conditions, being that she's an employee or office holder and has held the shares for at least 12 months prior to the date of disposal. So we've worked through the same formula for P2 and P3. However, as P2 has an indirect holding of 5%, it would be only P3 that would not pass through the ER gateway, as his indirect interest is less than 5%. Of course, if P3 has a direct holding in the JV company, this would be aggregated with his 3% indirect holding to see if he meets the 5% threshold. So move on to example 2. Now the facts in example 2 are the same as in example 1, but this time there is a company which I've called Midco, which sits between the investing company, IC, and the JV company. Again, we follow the same process, except this time there's an extra element to the formula. So we've got R multiplied by S multiplied by T multiplied by 100. So it's getting a little bit longer. We now know what R and S are in the formula, and T in the fraction is the ordinary share capital held by Midco in the JV company. So if we start with P1 again, we multiply R, being her 55% holding in the investing companies, by S, being the investing company's deemed 100% holding in Midco, by T, which is Midco's 20% holding in the JV company. And this formula tells us that P1 has an 11% indirect interest in the JV company, and therefore passes through the ER gateway. Now, the reason why S in the formula was 100% rather than 50.1% is because, as previously mentioned, the legislation tells us that if the investing company holds more than 50% of the ordinary share capital, it's deemed to own 100%. So as you'll note, P2 gets through the gateway, but P3 doesn't. So example 3, again, it's exactly the same as example 2, except here the investing company owns 50% rather than 50.1% of Midco's shares. Now, as the investing company owns 50%, the legislation states that we use the actual percentage for T within the formula. As a result, P1 would now get through the ER gateway, and P2 and P3's holding would not be eligible for ER unless they have a direct interest, which takes their indirect stake together with their direct stake up to the 5% threshold. Again, as I mentioned at the outset, if the investing company is carrying on trading activities whose activities do not include, to a substantial extent, activities other than trading activities, then all 3 shareholders would be eligible for ER in any event. So, moving on to partnership structures. Before the Finance Act 2015, a corporate partner was treated as carrying on a proportion of the activities carried on by the partnership. And as I noted at the outset, the Finance Act 2015 broke this link, so that unless the company carried on a significant trade of its own, the shares would not be eligible for ER. Now, the Finance Bill 2016 changes this so that the activities of a company are treated as trading activities where the company is a direct interest company, which is a DIC in the diagrams going forward, or a relevant corporate partner, at RCP, in relation to the individual. And the individual must have a direct or indirect interest in at least 5% of the partnership's profits and assets and the votes. Now, these are 2 new terms, the DIC and RCP, and we'll look at what they mean and how they impact on the formula. It should be noted that the direct interest company has to be a member of the partnership for at least the 12-month period prior to the disposal of the shares in order to qualify for ER, in order to avoid the activities being treated as non-trading. So let's have a quick look at the formula. An individual's indirect interests in a partnership via a direct interest company is measured by the formula R multiplied by V multiplied by 100, where R is the fraction of the ordinary share capital that the individual has in the direct interest company, and V is the lower of the fraction of the profits and assets in which the direct interest company holds in the partnership. It should be noted that there is a voting test which states that where the interests are held via a direct interest company, it's the individual's holding in the direct interest company which dictates the level of votes, and not in the actual partnership itself. And where there's more than one direct interest company, the interests are aggregated. So let's look at an example which hopefully makes this clear, because it's actually quite complicated stuff. So if we look at example 4 here, in this example we have 3 shareholders, P1, 2 and 3, who together hold 100% of the shares in the direct interest company. The direct interest company has a right to 75% of the partnership's profits and 20% of the assets. In order to determine whether P1, 2 and 3 get through the ER gateway, we need to apply the formula to their holding in the direct interest company and the direct interest company's holding in the LLP. So again, if we start with P1, she holds 55% of the ordinary share capital in the direct interest company. And again, for simplicity, we've assumed that the ordinary share capital and the votes are the same. So we multiply her 55% holding in the direct interest company by the lower of the company's fraction of the profits, which is 75%, and the assets, which is 20%. Therefore, it's 55% multiplied by 20 multiplied by 100, which is 11%. This means that for P1, she has an 11% indirect interest in the LLP, which means that the LLP's trade is imputed into the direct interest company for P1. Now that P1's through the ER gateway, providing the LLP is carrying on a trade and is not simply holding assets as investments, P1 should be entitled to ER on the sale of her shares, provided that the other conditions are met. As P3's indirect holding is less than 5%, his holding in the direct interest company would not get through the ER gateway, and therefore the LLP's trade would not be imputed into the direct interest company. Of course, if P3 was a partner in the LLP in his own right, such that when aggregating his direct and indirect interest, he satisfied the 5% threshold, then that would get through the ER gateway. So we come on to the next example, which is example 1 here. A indirect interest may be held via a relevant corporate partner, which is defined as a company which is part of the same group as the direct interest company, and which is also a member of the partnership. For such structures, we need to consider 2 more formulae. So let's look at more examples here, which again will hopefully make the position clearer. The facts in this are the same as in the last example, but this time there is a company, the relevant corporate partner, sitting between the direct interest company and the LLP. Again, we follow the same process, except this time there's an extra element to the formula. P's interest via the relevant corporate partner is calculated by the formula R multiplied by V multiplied by W multiplied by 100. Now we know what R and V are in the formula, but W is the fraction of the ordinary share capital owned by the direct interest company in the relevant corporate partner. Therefore, if we multiply 55% multiplied by, so if we start with, P1 again, if we multiply R being her 55% holding in the relevant corporate partner by V being the direct interest companies deemed 100% in the relevant corporate partner, by the lower of the relevant corporate partner's fraction of the profits, 75%, and assets, 20%, it means that we multiply 55% by 100% multiplied by 20% multiplied by 100, which means it's 11%. So the formula tells us that P1 has an 11% indirect interest in the LLP, and therefore passes through the ER gateway. As you'll note, P2 gets through the gateway, but P3 doesn't. And in the final example, The facts are the same as in the last example, but this time the direct interest company only holds 50% of the shares in the corporate partner, which means for the purposes of W, we are using the exact percentage rather than the deemed 100%. This means that only P1 would get through the gateway. So in summary, the Finance Bill 2016 changes are very welcome, but they have not been completely reinstated the pre-Finance Act 2015 position, which means that the legislation is now even more complex than it was before, and determining whether an employee qualifies for ER is far more complicated in certain group situations, and as a result, the risks of getting the answer wrong are much greater. So now I'll hand over to Chris Chappell, who will provide a detailed summary of the new investors' relief rules.
Thank you, Matthew. I can confirm there is no algebra in the following presentation. Hopefully we'll hang on to a few listeners. As Matthew mentioned at the outset, the Budget and Finance Bill 2016 contains some major changes to the capital gains tax landscape and the tax reliefs designed to encourage investment and entrepreneurial activity. One of a number of surprises was a new relief for external investors in unlisted trading companies, which has come to be known as investors' relief. We expect this new relief to be useful in a number of cases, for example, where investors have exhausted already their entitlement to entrepreneurs' relief, where a company is seeking to attract investment, but its trade is excluded from SEIS or EIS, such as hotels, property development, or property dealing, or where a company has outgrown those reliefs. It may also serve as a safety net for investors whose shares initially qualified for EIS or SEIS, but have since become disqualified. The qualifying conditions are, at least in their current draft form, much simpler than those applying to EIS, which may allow much wider use of the relief, for example, in the context of transactions funded by venture capital or other financial investors. And it's important to note that the law is not yet final, and as recently as Monday, changes were being proposed which are subject to debate in Parliament. So with that caveat in mind, we'll continue with a brief overview of the relief as it stands. Investors' relief will offer a 10% capital gains tax rate to individuals who qualify. A lifetime limit of £10 million will apply. It will apply on disposals of shares in an unlisted trading company or the holding company of a trading group. Neither the investor nor anyone connected with the investor can be an officer or employee of the company, although there are some proposed exemptions from this rule announced on Monday, which we'll come to later. The shares must be ordinary shares subscribed for and fully paid in cash, and these must be held for at least 3 years. There is also a fairly standard anti-avoidance proviso, so the shares must have been subscribed for genuine commercial reasons and not part of a tax avoidance arrangement. When George Osborne first introduced the relief, he described it as an extension of entrepreneurs' relief. In fact, the relief is entirely separate to entrepreneurs' relief and has its own £10 million lifetime limit. Unlike entrepreneurs' relief, there is no minimum qualifying percentage holding. You can have a mixture of qualifying, non-qualifying, and potentially qualifying shares, and as a result, there are matching rules which set out the order in which shares are treated as being disposed of for tax purposes. Some anomalies do persist if we look at the different tax reliefs together. For example, an employee who holds 4% of a company is neither eligible for entrepreneurs' relief nor investors' relief, whereas a non-employee would qualify. And David's going to offer a comparison of these various reliefs a little bit later on. In terms of the main qualifying conditions, the company must have been a trading group or the holding company of a trading group throughout the entire shareholding period. But there are currently no restrictions on the type of trade that is permitted, which makes it broader, of course, than the existing EIS relief. The shares must be ordinary shares, and ordinary shares has a specific tax definition, which is stated on the screen. So ordinary shares are any shares that form part of the company's share capital, other than those which carry a right to a fixed dividend, but have no other rights to a share in the company's profits. The Shares must be listed, or must not be listed rather, on a recognised stock exchange, and for these purposes, shares listed on AIM are regarded as unlisted and so do potentially qualify. The condition that the investor must not be employed has been subject to some debate and lobbying, and there has been some change on this. Originally, it was a requirement that the investor must not have been an officer or employee of the company at any time while the shares are held, and similarly, no person connected with the investor could have been employed. Persons connected with the investor include business partners, the individual's spouse or civil partner, relatives such as brothers, sisters, ancestors or lineal descendants, or the spouse or civil partner of a relative. And this was an extremely restrictive definition. There was originally also no carve-out for business angels, which made it potentially more restrictive than EIS, although the test did not look backwards. In other words, a previous employment did not necessarily disqualify you. As of Monday, this position seems to have been relaxed slightly. This now allows an unremunerated director, a business angel effectively, to benefit from relief, but only provided he was not previously connected with the company, including by way of employment. A director definition now specifically includes shadow directors, in other words, those who act as directors but without a formal office. There is a further relaxation for individuals who become employees where this is not within 180 days of acquiring the shares, and there is no quote-unquote reasonable prospect of that employment at the outset, and that's clearly going to help in cases where relief might inadvertently have been lost by, for example, a person connected with the investor taking up a junior employment position in an investee company. There are complex rules, this being tax, on how shares are treated on a reorganisation that investors will need to be aware of. Essentially, there is deemed to be no disposal of the shares on a reorganisation, and the holding period and qualifying status of the old shares tracked through to the new shares. Where there is a share exchange between one company and another, investors can disapply this no disposal treatment and trigger a taxable gain. An investor might choose to do this, for example, if the new shares would not qualify, whereas the old shares did, for example, because the new shares will be listed on a recognised stock exchange. There are further complex rules which disqualify the shares in the event the value is received by the shareholder in the period starting 1 year prior to the acquisition and ending 3 years afterwards. These are modelled on the existing EIS rules and apply to events such as share redemptions, loan repayments, and other sorts of benefits. And this does mean that investors will need to continue to monitor closely the qualifying status of their investment after they've made it. The provisions regarding ownership through partnerships and collective investment schemes have also been subject to debate. The law originally required that the investor be the sole holder of the shares, and given that private investors frequently prefer to invest via collective entities, for example partnerships or EIS funds, this seemed to frustrate the policy intent of helping unlisted companies raise finance. Helpfully, new provisions published on Monday reverse this treatment and explicitly allows for joint interest in shares to qualify. There are now also new provisions on trust disposals, although any relief on a trust disposal is offset against the limits available for qualifying beneficiaries. There is no doubling up of relief. These changes are all welcome and will make the relief available to a wider pool of investors and investee companies that would otherwise have been the case. One final point on timing, however. Importantly, this relief applies to share acquisitions made on or after the 17th of March 2016. But as you can see, the full details of these rules won't be available until royal assent of the Finance Bill, which is not expected until autumn 2016, the usual parliamentary process having been delayed by the Brexit vote. Individuals who may potentially qualify for relief will therefore need to consider very carefully the terms on which they invest, or conceivably to seek to delay that subscription. So the tentacles of Brexit spread far and wide. On that note, I will hand over to David to talk about EIS and related matters.
Okay, so I'm going to talk about the so-called venture capital reliefs, VCTs, EIS, and seed EIS investments. So first of all, just a bit of background to these reliefs. They were introduced to encourage investors to invest in higher risk, unquoted companies in return for some tax benefits, and in particular for an upfront income tax relief on the investments that are made. And there are also upside and downside tax protections as well in the event of the success or failure of the company, which we'll talk about a little bit later. But broadly, the reliefs, they are treated as a state aid for EU purposes, and the intention is to solve the funding gap for small and higher risk companies. So if we just look at the comparison between the reliefs, you'll notice the first two, EIS and seed EIS, the first two columns, these are for direct investments in unquoted trading companies, whereas the final column, a VCT, is itself a listed PLC, and so the investor invests in the VCT, receives the tax relief on that investment, and then the VCT invests in a range of unquoted trading companies beneath it. So effectively, this is an indirect investment in unquoted trading companies. The CDIS, as we'll see later on, is aimed at startups in the first 2 years, and also smaller size limits apply. And obviously, because of the higher risk associated with that, you'll notice in the first line there, the income tax relief for CDIS is at 50% rather than 30% for the others. It's worth noting too that the income tax relief works by reducing an individual's tax bill. So if you subscribe £100,000, you're entitled to up to 30,000 tax relief under EIS. But if you've only paid 25,000 in tax, then obviously you could only claim a 25,000 cashback in that instance. There are also maximum investment levels. So you'll notice EIS is £1 million, CDIS is only £100,000, VCTs at 200. And you can, with EIS, put up to 2 million because you could go back 1 year provided you've still got any of your previous year's allowance left. So quite a generous relief really if you've got high enough income to be able to use it. All three of them benefit from a tax-free exit provided they've been held for the qualifying period and met the rules, which is a huge benefit to be exempt from capital gains tax. You'll notice that only a VCT has tax-free dividends. The EIS and CDIS companies, you are taxed on dividends. And the VCT doesn't have any kind of CGT exemption on other gains, whereas with EIS, if you make a gain elsewhere and then you invest that gain into an EIS company, the original gain is deferred until the EIS shares are sold. With CDIS, there's an even more generous arrangement where there's a 50% exemption, and again, I'll give an example of that in a minute. The qualifying period's 5 years for VCT, 3 years for the others, and there are some specific rules on whether you can be a director. It's okay under CDIS. For EIS, you have to meet the so-called business angel provisions, which I'll talk about in a minute. IHT BPR, the final one, this is an acronym, obviously, for Inheritance Tax Business Property Relief. So this isn't specific to EIS and CDIS, but if you meet those requirements, then you would qualify for the inheritance tax relief. VCTs investments would not qualify because it needs to be an unquoted share and a VCT is fully listed. But for the rest of the presentation, I'll focus mainly on EIS and CDIS because they're the direct investments that are more comparable with ER and IR. So just an example on seed EIS. So if you have an individual who's made a capital gain on a second home of £100,000, so under the current rules he'd be subject to the highest rate of capital gains tax at 28%. If he chose to invest that gain into a seed EIS company, he'd qualify for a 50% income tax relief. He'd also be able to claim 50% relief on the capital gains tax bill, so an effective rate of 14%, so another 14,000 relief. So that investor has a £100,000 investment, which has only actually cost 36,000 net of the tax reliefs. If we then take perhaps a pessimistic approach, if you like, and look at downside protection, what happens if the company goes bust? Well, if you look in the first column there, you can see that the allowable loss is the loss after the income tax relief. So in the CDIS example, it's at 50,000. And that can either be a capital loss to set against other capital gains or to carry forward, but that would obviously generally only be relieved at 20%, the CGT rate for most purposes. For EIS and CDIS companies, it's possible to claim by election to set that loss against income for the current year or the prior year. So that means that you could actually get relief of up to 45% on income. So you can see there the example, there's another 22,500 income tax relief available. So the net loss after the upfront income tax relief, the income tax relief on the loss and the CGT relief means that the net loss after those tax reliefs is only 13,500. Now obviously we hope that won't happen, we don't want to invest with the hope of a loss, but it's good to know that that downside protection is there, that for 100,000 investment, the actual loss is only 13,500, provided you have sufficient tax base to use up those losses. The EIS example in the next column is a little bit more straightforward. So 100,000 invested, 30,000 income tax relief. And again, if the company went into liquidation, nothing was returned, then that 70,000 could be set against income with up to 45% relief, which gives 31,500 relief. And so the net loss in that example is 38,500, which again just buffers that downside. So if we just consider what the investor has to do to qualify for the reliefs, to qualify for all the reliefs for EIS, then the individual can't be connected with the company. Now, if an individual is connected, it means they can't claim the income tax relief and they can't claim the exemption on exit, but they could still claim a deferral relief. So you get instances where someone owns 100% of a company, they could still qualify for deferral relief, but not the other parts of the relief. So the rules say you can't be connected, which means you mustn't be an employee. You may be a director for a CDIS investor, and also for an EIS investor, provided you meet the so-called business angel rules, which mean broadly that if you subscribe for shares first and then become a paid director subsequently, then that's okay. Also, you mustn't have a substantial interest in the shares, which is a 30% test, and that applies to the individual and their associates. They mustn't have more than 30% of the nominal value of the share capital, mustn't have more than 30% of the votes or of the assets on a winding up. And I mentioned there the individual and their associates, so you couldn't have a husband and wife with 30% each, because for these purposes, their holdings would be added together as associates. So associates include business partners, spouse, parents, grandparents, children, grandchildren, so lineal descendants and ascendants. But in contrast to the investors' relief and other tax reliefs, for EIS and CDIS, brothers and sisters, uncles and aunts are not treated as associates. So it would be possible for two brothers to own 30% each without breaching the rules. Various other requirements, such as no linked loans, the investment can't be for tax avoidance reasons, except obviously there's always an intention to claim the tax relief, so it's a slight anomaly there. And there mustn't be any value received from the company, which is similar to the point Chris discussed earlier. And this really is there to prevent somebody putting some money into a company and getting the income tax relief and then taking the money back out again by the back door. But it's quite broad, so as Chris mentioned, it covers repayments of loans in certain instances and also buybacks of shares and even buybacks of non-EIS shares as well. There's just the final bullet point there is a bit of a trap that the tax-free disposal can't be claimed unless at least some income tax relief has been claimed. So you need to claim at least £1 worth of income tax relief. And you do occasionally get people who are within their annual exemption and not paying any tax. So sometimes you might want to disapply the tax allowances in order to be able to claim £1 of income tax relief. The next example just shows for EIS how, with a combination of the reliefs, you can get up to 98% tax relief. And this is where, if a deferral claim has been made and the individual dies, then that claim washes out on death. It doesn't come back into charge. And then, of course, after 2 years ownership, you also get the inheritance tax relief as well. So a maximum of 98,000, and you'll often see this in the investment memorandum. The key point to note, of course, is that you have to die to get the relief, so it's quite drastic tax planning, but it's useful to know that it is there, and for people at certain stages in life, EIS investments can be very attractive from a tax perspective. As far as the companies are concerned, the companies have to meet certain rules as well. So in terms of size, there's a maximum number of employees. For EIS, it has to be fewer than 250 employees. And for what's called a knowledge-intensive company, less than 500 employees. And for CDIS, must be fewer than 25 employees. There's a gross asset test immediately before the investment, which is 15 million for EIS and 200,000 for CDIS. Because this is state aid, as I mentioned before, there is a 5 million limit in any rolling 12-month period. And this applies to CDIS, EIS, VCT, and also other forms of state aid, so things like certain grants, government grants can also be brought into this. There's also now, since November 2015, a lifetime limit for EIS of 12 million. And again, that 12 million includes all kinds of qualifying state aid. And then trading period, CDIS, the company has to be in its first 2 years of trading, as I mentioned before. And again, since November 2016, there's a 7-year life for EIS investments, subject to certain exceptions. So I'll mention this a bit later on. Other rules for the company, just like for investors' relief, they must be unquoted shares, which includes AIM, and they must be new subscriber shares and fully paid. The topco in the group must have a UK permanent establishment. It has to be an investment in the topco. It can't be under the control of any other company. The use of the money mentioned there, this is tightened up because it has to be spent within 2 years for EIS. But there was the change in November 15, isn't it? The growth, the money has to be used for the growth and development of the business. So again, I'll touch on that a bit later. And most significantly, perhaps, the company has to carry on a qualifying trade. So there's a list of excluded trades, and the company mustn't carry on more than 20% of its activities in one of these excluded areas. And they include generally property-backed things, property development, property investment, other kinds of investments, and other things that they view as being low-risk trades, such as accountancy and legal services, for example. So there is a list there that can be looked at, and things are added to the list. So solar was an acceptable trade for a while, but that's now been added onto the excluded list, so that has to be checked. And as I mentioned, the company has to receive its first investment within the first 7 years of its from the first 7 years since its first commercial sale, and 10 years for a knowledge-intensive company. The shares themselves have to be ordinary shares, fully paid up, without present or future rights, preferential rights to dividends or assets unwinding up. They mustn't be redeemable, and they can't have any protection against risk or a prearranged exit. They have to be full risk shares. Now, there's been quite a lot of turmoil since there were some changes to the EU state aid rules, and the government announced that there would therefore have to be corresponding changes to the EIS, CDIS and VCT rules. And these changes came in from royal assent of the Finance Bill, which was on the 18th of November 2015, and this is a list of those changes. The first one is a bit of a trap, that the investor must be independent of the company when they first invest. So in the past, you could have, say, £100 worth of shares in a company, and then later on invest in with £100,000 and claim EIS relief on the second investment. Now, unless you claim EIS on the first investment, you won't be able to get relief on the second investment. So that's a trap to watch out for. There's also, as I mentioned, a lifetime limit of 12 million or 20 million for knowledge-intensive companies. And because this is state aid, you've got to figure out any grants that have been received during the life of the group, because you have to look at all the group companies, and you have to look at companies that have at any time been a member of the group as well, so you can't just take a company out of the group to escape this. And as I mentioned, the company has to receive its first risk finance investment within the first 7 years. So it's well worth thinking about an EIS investment in the first 7 years, just so that you can then take follow-on EIS investment later. The money raised can't be used to acquire any existing business. Now, the rule was changed a while ago so that you couldn't acquire shares with EIS money. Now you can't acquire traded assets and goodwill either. So this has been quite a significant change in how the money can be used. And as I mentioned, the money has to be used for the growth and development of the trade of the company or the group. And HMRC are asking a lot more questions now when we send in clearance applications, which you can get in advance of investment. They'll ask for copies of cash flow, business plans, and so on. So that's a big change. The final two are just a couple of technical changes which I've put on there for completeness. So let's compare the reliefs then. So I've compared EIS with ER and IR. Now EIS has a maximum investment limit of $1 million, the others don't have that. But EIS does have this income tax relief of 30%, which the others don't have. EIS, there's an exemption on capital gains without any cap, so it's very generous, whereas ER and IR are both 10% CGT rate on the first 10 million of lifetime gains. With regard to loss relief, setting that loss against income tax, you can do that for EIS. We've put no on ER and IR. It is possible, but more unlikely for those two, whereas the rules are similar to the EIS rules. There's a deferral relief for EIS, which there isn't for the others. And then just skipping down towards the end, you'll notice the holding period. There's 3 years for EIS and IR, but only 1 year for entrepreneurs relief. And also you should note that EIS and IR, you have to have subscriber shares, new shares, whereas ER, it can be second-hand shares bought from someone else. But of course, EIS and CDIS, the level of complexity and the rules are much higher than the other two reliefs. So which is best then, if you like, from a tax perspective? Well, CDIS with its 50% upfront income tax relief and CGT exemption is the best, but clearly it comes with tight conditions and it has to be a startup, high-risk business. EIS I've put as second best because it's got a 30% income tax relief and deferral relief available as well. VTT I've put in third place because it doesn't get the deferral relief or the inheritance tax relief, but it does have tax-free dividends, so it depends on circumstances really. And ER and IR are neck and neck in terms of tax relief, both having no upfront relief but a 10% CGT rate. Now, of course, you can't just choose between these reliefs. It depends on the type of investor. So if we have an outside investor who's not a director, not an employee, then potentially they could qualify for all the reliefs other than entrepreneurs relief, because obviously they're not an officer or employee. So you'd first check whether CDIS was appropriate, but that's only startups. EIS, is that appropriate, or VCT? Well, again, you'd have to consider the qualifying trade and the size limits. And so this new relief, investors relief, as Chris mentioned, is really an excellent backup if you find that you don't qualify under the venture capital reliefs, maybe because of the type of trade, maybe because it's outgrown its size limits or some of the other EU limits. So I think IR will become a very valuable relief. The next one there is where you're connected with the company as a working director. So that's still possible to get CDIS and EIS, and also to get ER provided there's a more than 5% holding. But obviously investors relief is not available in that situation as an officer or employee. And then finally, if an individual is connected as an employee but not a director, then really the only option is entrepreneurs relief, provided they've got the 5% holding. CDIS, EIS, IR, none of those would be available because the individual is an employee. So it's quite interesting to compare and contrast the various reliefs. Of course, in an OMB situation, where an employee shareholder sells out, you might start with entrepreneurs relief, but once that lifetime limit's been hit and they've sold out of the first business, using investors relief, they'll now be able to invest as a follow-on investment, as a more of an arm's length investor in another investment. So it will encourage serial entrepreneurs, I believe, and I think it will be a very valuable relief. Another area investors' relief could be really valuable is if funds are going to be allowed. It sounds like from the changes on Monday that this could well be possible. Because at the moment there are a number of EIS funds and VCTs that can't make follow-on investments because the companies have outgrown the size limits. And so if you could have a fund that focused on investors' relief, it could mean that those companies could get the follow-on investment that they might so desperately need. So that's my conclusion, summary of the reliefs.
Okay, thank you, David. So we've covered quite a lot in a relatively short period. And I know we've received some questions which we'll endeavour to answer. The first question we've got, is it possible to claim SEIS and EIS? David, do you want to?
Yes, obviously not on the same amount, but if an individual subscribes, they can get CDIS relief on the first 100,000 of the investment, and then EIS on the balance. It used to be the case that you had to spend 70% of the CDIS money before the EIS shares were issued. That's now been relaxed, so you can subscribe on the same day as long as the EIS shares are issued the day after the CDIS shares. So it is possible to get both.
Thank you. So I think actually there's another question for you, David. David mentioned receipt of value and share buybacks. Could you expand on that, please?
Yeah, so the receipt of value rules on a share buyback, obviously if an individual is an EIS investor and have the shares bought back, then the relief is reduced proportionately. So if 100,000 is bought back, they'd lose 30% relief on 100,000 and have to pay back, and they'd lose the corresponding CGT exemption. There's also a rather harsh rule that if a non-EIS investor has shares bought back by the company, then the relief is clawed back across all the EIS shareholders pro rata if they're still within their 3-year period. So that's a bit of a trap to watch out for.
Okay, we'll just have a quick sift through and see if there's any other questions. Hold on. We've got another question here. It says, is there any registration with HMRC at the time of investment, or can reliefs be claimed when submitting tax returns?
As far as CDIS and EIS are concerned, and VCT, there is what's called an advanced assurance process, so you can apply for this assurance or clearance from HMRC. HMRC will only say that the trade and the company's shares qualify. They won't comment on whether an individual is connected with the company or not, so they won't go into individual situations, but they will give a clearance on the trade, which is always helpful. You don't have to go for it. You could just issue the shares, and then once the shares are issued and the company's been trading for 4 months, you fill in what's called an EIS-1 application form, and then the revenue send EIS-2 and EIS-3 forms back afterwards.
Just have a look, see if there's any other questions that are coming in. Maybe 1 second.
Sorry, there is a question about R&D, and R&D does count as the start of a trade when you start doing R&D, whereas the first commercial sale, that comes from an EU definition. So if you've done a few tester sales and things like that doesn't count as a sale for those purposes. It's only when the business actually starts selling properly and those tests are finished.
Any other questions?
There's one about whether, for example, a tech company could develop software for an excluded business and still be carrying on a qualifying activity. You do have to be careful. One of the excluded activities is providing services to a company that doesn't qualify for EIS. And so you do have to watch. It's only where there's some common control. So if somebody's got 30% and is a director of both companies, then you do have to watch that. But if it's just to a third party, then you can still provide services to a non-qualifying trade without an issue.
Okay, so if anyone has any additional questions that we haven't answered during the session, our contact details are on the final slide, and we'd be very happy to discuss these with you. So that all is left for me to do is to thank you very much for attending on behalf of all of our speakers, David, Chris and myself, and have a very nice day. Thank you.